Here.
Ms. Falconberry.
Here.
Mr. Dow.
Here.
We do have a quorum. So the first item on our agenda then is to approve minutes. There are 2 sets of minutes in our packet. Do we have any questions or comments from the committee on those minutes? Hearing none, do we have a motion to approve those minutes?
Oh, motion.
Second.
I'll second.
All in favor? Anyone opposed? All right, that carries. So next item on our agenda is the fund performance report for Mariner Wealth Advisors. Turn it over to Ms. Pam Thompson.
Thank you very
Thank you.
much. It's great to see everyone. So you have our presentation book in front of you, which has been updated to our new format. So you have on page 2 just a place for notes, if that's helpful for you. We thought that'd be a nice thing to just add in there. So the first few pages are just our kind of regular update on Mariner. So with our firm, there have not been any significant changes since our last meeting. We're just continuing to grow and giving us, more and more ability to do different kinds of things for our clients, but just kind of organized a little differently here. So turning to page 4, you can see just kind of a map of our office locations. And as you, I think, are already aware, we do have an office now in Lexington. Eric is the one who's here the most. I'm here from time to time as well. But we're working both in the Lexington office as well as Louisville. So I spend a lot of time on 64 there. We are still a privately owned firm, which is a really nice advantage together with being larger and larger, but it does allow us to really put our clients first at all times. And then on page 5, just highlighting again, the ranking by Barron's is something that we are very proud of. Since they started ranking RIA firms across the country, RIA just stands for Registered Investment Advisory Firms. So those are the fiduciaries working with clients. They've done a nationwide ranking now since 2016, and we've each year been in the top 5 nationwide, so we're very pleased by that and sharing that with you. Page 6 is just those within our local team who spend the most time in our Lexington office, here to help you as needed. Eric and I are your lead advisors, so we're meeting with you on a quarterly basis, but everyone else here is also part of that team and able to help if there's ever a need for someone else to step in and take care of things. So if we turn to page 7, we do like to always review your investment policy at the beginning, just as a reminder. This is your document giving us guidelines for how to invest on your behalf. So page 7 is a summary of that full document, and then all the details are behind it. But the most important part of this is the asset allocation listed at the top. These are just the guidelines on what proportion of your portfolio you want to have in stock investments versus bonds and cash. Stocks are what provide growth long term. So given that this is a fund that is intended to live in perpetuity, to pay out benefits for years and years to come, it's very important that it has growth. So we need that stock allocation for that growth. The target that you've asked us to have is 60% with a range of 50 to 80%. So we will be somewhere within that range at all times. But with stocks that do provide growth, we do get volatility from time to time. And so it is important to have a cushion. We're not going to have 100% in stocks. So the other part of the portfolio is intended to provide stability. So we're investing in very high quality bonds. The target there, 35%, range of 20 to 50%. So the bonds hold their value, and we'll get into the detail on that a little bit later, but then they're paying interest income. So it's still a nice amount you're earning there, but without the volatility that comes from stocks. Everything else about the investment policy is to make sure that it's well diversified, not too much in any one company, very high quality, and so those are all very important. The rest of the pages behind this, the rest of the section is just all the detail. There have not been any changes to this in several years, but we're always happy to discuss any aspect of it if there's questions or an interest in making a change. Okay. So we'll go ahead and go into that next section, behind divider 1 to page 18 is still kind of history for context as we look at just the stock market environment that we've been in. Page 18 is looking at 2024, so it's really just a reminder that it was a very strong year in the market, as was 2023. But you see 5 different lines here color-coded for the subtitles up above. With the U.S. stocks doing the best last year, so you had the S&P 500 in red, Dow Jones Industrial Average in blue, up 25% and 15% respectively. The orange is the Russell 2000, that's small company stocks, and then the gray and the yellow are international stocks. You can see everything was positive for the year, but much more so for the U.S. than the international stocks. And again, this is just the market in general, not your portfolio specifically. If you turn to the next page, it shows so far this year. So in 2025 through the end of October, you can see again, we're sitting at nice positive numbers again. You'll see in April, we did get a pretty sharp pullback that happened pretty suddenly after the announcement of a lot of tariffs that happened back then, but we actually saw that recover pretty quickly. Interestingly, if you look at which lines are above the others, we've had a reversal in terms of which stocks are doing better this year. We've actually had international stocks at the top, so that gray and yellow are the highest returns by far. The U.S. still doing quite well, but it is, from our seat, it is nice to see when diversification is actually paying off, and it is important to maintain, different elements within a portfolio. But this has certainly been a year for diversification from that standpoint. And then one more commentary page for stocks on page 20. And we've shown different things from time to time to illustrate the concept. When we look at the S&P 500, that is broadly, the most common index that's used to look at, okay, how are U.S. stocks doing? As the name implies, the S&P 500 has 500 stocks in it, but it is an index that has become more and more concentrated over time, and this is a chart that kind of illustrates that. I'm going to look at the chart on the right is really what makes the point that I want to make. Over time, this is looking at just the percentage of that index that is made up of just the 10 largest. So if you look at the 10 largest companies in that index, that's the gray line, looking at what percentage does it make up. And it's because that index is what we call market capitalization weighted. So the largest companies make up the biggest proportion. And what we've had is these largest companies, which are mostly the big technology companies, have gotten bigger and bigger and bigger. And they are now 41.6% of that entire index. So even though there are 500 companies, 10 of them are getting to almost half of the whole thing. And so, not good or bad, it's just important to know what we're looking at when we're looking at that index. And so it's becoming more a reflection of how a handful of companies are doing, and it's become less as, a reflection of the full market, which is why we like to look at a lot of different stock indices to get that full picture. One more commentary page on the next page, page 21. Just looking at the bond market. So this is just looking at interest rates for treasury bonds across different maturities of those bonds. Each line is a different point in time, but that dark blue line is the most recent. So that's as of October 31st. And what we see is that, bond interest rates have come down some from the highest that they reached. That's that lighter blue line. But we would say this is still quite attractive from an investment standpoint. It is really nice after, a decade or more of super low interest rates that we had a while back. It's nice that we were finally able to earn a nice amount of interest on bonds. And so that's, really what we're seeing here. Okay. And I'll do just the portfolio summary and then hand it off to Eric for the detail. But on page 22, here's where we're looking at a snapshot of your portfolio. This is as of October 31st. Your overall asset allocation, we had equities at 73%, so right there in the midst of your range. But in the pie chart, you can see how that is delineated across many different subcategories. So large cap equities is the largest individual piece at about 50%, but we do have diversification into small cap, mid cap, international commodities as a position in gold. All of that together makes up that 73%, so it's a nice diversification there. And then the remaining 27% of the portfolio is in that fixed income, the bonds, and the cash. And then looking at the returns on that upper right-hand side there, we're looking at the total portfolio as the top row of numbers, and then as well as the fixed income component and the equity component. So fixed income being bonds, equities being the stocks. So on an overall basis for the entire portfolio, year to date through the end of October, the total return has been 12.4%. So very nice return. And that's blended between the stocks and the bonds. So the stocks overall, all these kinds of stocks together had a return of 15.8%, while the bonds had a return of 5.5%. So it's so far turning out to be a third year in a row of above average, higher than we would typically expect. So you can still see last year, 2024, at 14% overall, 2023 at 20.9% overall, and then just that long-term running kind of return of what we've had the past 10 years now through October, it's actually averaged 9.4% per year. And this is great. It's wonderful to have this. I would also caution, as we do with all clients right now, we're in our almost 3 years now in a row of really above average returns. We want to recommend you we don't want to expect that, right? So when we're looking at a portfolio that is balanced with, 2/3 or a little bit more in stocks and about 1/3 in bonds, that's great, but there will be times that stocks come down, and so it's just right now a little bit higher than what we would say to expect long term. But of course, it's good. It's great while it happens, for sure.
Now, Pam, just a question real quick, not to interrupt everything, but
Yeah.
before we move on, what is it's above average right now at
Yeah.
9.4. What
Yeah.
is the average in most organizations or most companies?
Yeah, and the way I would answer that is to say it's what's in stocks and how much is in stocks and how much is in bonds. So what we would say to expect from stocks long-term, the stock part of a portfolio, we would say 8 to 10% per year. So it's in that range, but has bonds in there too.
Right.
And I would ask Steve Jason, this might help you. What is our plan assumption when you do your actuarial work?
I think it's 6.
6.
I believe it is 6%.
Yeah.
So Jason, that's where your frame of reference
Yeah.
is.
Okay.
The math that Steve does is based on 6%. The returns that we're seeing are stronger than 6%.
Right.
That's good.
Yeah.
That's the,
Yeah.
Yeah.
And so the way I would say at any point in time, we would say the way we would target a projected or expected, likely return long-term is that amount that's in stocks at 8 to 10%. The amount that's in bonds depends on what are the current interest rates. So as we were talking about earlier, we are now in an interest rate environment where we are earning more on bonds than we were. That's great. If that continues, then from these points forward, we can expect that level of return. So call it 4 to 5% from bonds versus what it had been for a long time of 2 to 3%. So with that 4 to 5%, if interest rates do stay at about that level, we can start to then say, okay, if it's 70% of the portfolio or 65% of the portfolio at 8 to 10%, 35% of the portfolio at 4 to 5, it's the blending of that, which is probably around 8%, 7 to 8%. But it can certainly change based on interest rates too, and that does make a difference for sure.
Thank you.
And then just one other summary page before I hand it off to Eric on page 23. It is just kind of an accounting that the system kicks out, but interesting to see on a calendar year basis, the past 3 calendar years, in dollars, where did we start the year in total, the net flows in and out, and then the amount you've earned or the return in dollars instead of percentages. So for example, so far this year, in that year-to-date column, beginning market value was 23.8 million. So far, there have been net cash inflows of almost 42,000. Dividends and interest, as well as bond accrual, which is interest that just hasn't been paid yet, but it's already earned. So those two together, so about 440,000 of dividends and interest so far. But then market value, and this is where the stocks come in. So in a strong market environment, you're going to get those growth pieces. So 2.5 million so far this year in just the growth. But it hasn't been all that long since we had 2022, which was a negative year. And so those do happen. The more positive years we get raises the likelihood that we're going to see another negative one, but we're not projecting that, but it's just something to keep in mind. So, okay, I'll hand it back to Eric for the detail.
So as we always like to do, a refresher on how we look at the equity portfolio, how we kind of organize it and balance it as the actively managed component of your equity portfolio, and the lead to the complement of passive, to understand how we look at the different tranches of the different blocks of stocks. And so on the far left-hand side, you have our growth and income category. Growth and income defined or highlighted as your stable growers, your basic blocking and tackling that identify themselves through a low beta, beta being a measure of volatility relative to the S&P 500. As a reference point, the S&P 500 has a beta of 1, so anything less than 1 has lower volatility than the overall market. Anything greater than 1 has higher volatility than the overall market. And we want this group largely, if not exclusively, to be, again, that the boring group. They also identify themselves through typically a dividend process, and not the highest dividend yield that's available, because often that's fool's gold, but a dividend growing process that shows that, yes, we are rewarding our shareholders, we are paying people to own us, and returning capital to our shareholders, but we're doing it from the basis of a strong balance sheet. And the evidence of that is that, again, we're not just paying a high dividend yield, but we are consistently growing that dividend because the company, has the earnings in which to do that. So it's a financial proof of life, if you will. And so this list at the top, starting with PNC Bank, which identifies itself as the boring bank, is a perfect example of that, with a solid dividend yield of 3.6% that grows at 7% per year, and a beta right at the market of 1 is an excellent example of that group that is the foundation of the equity portfolio. The center group is the cyclical group. Cyclical by its very nature is the group that is going to be rewarded at different parts of the market cycle. That where the market is currently rewarding is where we will see the benefit. And so currently there are names like financials, which are doing and have been doing very well, and as the interest rates adjust, that has been to bank earnings benefit. We've also seen a momentum behind mergers of some of the regional banks, and I think we'll probably continue to see that. So that's playing into that group, as well as reindustrialization, and so names like Eaton that build things and support the building of things. Notably, data centers would be one of those. You may have heard of that happening nationally and locally. Falls into that group. So this group is going to identify itself with strong, not hyper, but strong earnings per share growth, and I would say reasonable to maybe slightly higher price to earnings ratio than the market as a whole, but more in line. Again, not hyper like some of the tech names that we'll discuss here momentarily, but more in line. And so price to earnings growth rates in the low to mid double digits is pretty emblematic. and again, price to earnings ratios that similarly are closer in that either high single digit or high double digits or low 20s, which in today's market is right down the middle of the overall market. And then on the right side, you have the newsmakers, the high flyers, and the high growers. And this, for our market, for the last number of years, has really been the driver. As Pam points out, 41% of the overall market is driven by 10 names. And I don't think it would take a whole lot to guess what category or what group those 10 names would align themselves in. So that's where we're seeing the high growth. The high growth shows itself with a higher earnings per share growth. So I think one of the healthier things about this market, as opposed to a tech bubble market that is commonly compared to, is that the actual earnings are strong. In fact, if you look at a company like NVIDIA, its earnings growth has outperformed its share growth, which is quite a remarkable feat. And you do see higher price to earnings ratios here as investors are willing to pay up for future growth. So it's not even, again, thinking back to that original chart where the actual earnings are now, but how rapidly those earnings are growing is leading to a number of these names being called out. One of the things, if you do as I do, compare this chart to previous books, what you'll notice is that while our weight in this section hasn't grown, the length of the list of names has grown. We've added names to it while not adding necessarily weight to this column. As more companies kind of identify themselves as not having been fully rewarded yet, that we have some diversification in here. Diversification, for example, with Blackstone. Blackstone is a financial company, but it's also a fast-growing financial company. They're now managing somewhere in the in the double digits of trillions of dollars of capital globally, and earning quite a bit on the fees that they get for managing that. And so names like that are being rewarded as their earnings are coming. But you do see a lot of your traditional, whether it's Mag 7 or the top 10 or the tech names in this category. If we go to page 25, you'll actually find your list of top 10 within the equity component of your portfolio. And again, you're going to see a number of names, and I've made the point previously, while a lot of these names line up in the tech category, we are quickly approaching a time, I believe, where that is going to be a category that gets diffused into other things. It's already started to happen. For example, Google is in communication services instead of tech. Those types of things will continue to happen, but it all ultimately centers around a tech theme. But if you were to add up your top 10, it would be lower than the top 10 of the overall market in terms of percentage weighting. So you are significantly more diversified, though you have exposure to those higher growing names. You do have additional diversification, which is appropriate, again, for the goals and objectives of the pension itself. If we go to page 26, you see the sector breakdown. And again, this is not something where we take large bets. While we are active managers, if you were to line this up with the weightings of the overall market, you'd be roughly in line. In some cases, maybe plus or minus 1 or 2 percentage points, which equates to the addition of 1, maybe 2 names, or subtraction of maybe 1 or 2 names from those categories. So there's no large bets, again, appropriate to a diversified equity portfolio. Your passive holdings make up 31%, and in the debate or the argument of whether active is better or passive is better, the answer is statistically and historically proven to be a resounding both. That a combination of the two is better, is an additional layer of diversification. There are times when active management outperforms. We believe we are in that such an environment now, and there are times when passive management outperforms, just having the bulk exposure. But you have, in effect, just under a third of your equity portfolio in passive index tracking ETFs, which include a growth index, IWF, which is up a little over 21% for the year, and the value index, which, not surprisingly, is positive 12% for the year, where growth has certainly outperformed value. The mid-cap exposure coming through the Russell 2000 index, the IWM ETF is up 12.3% for the year, and your international index, the EFI, Europe, Asia, Australasia, Far East, developed markets, primarily index, is up 27% for the year. Again, lining up exactly with what Pam was discussing earlier in terms of what we've seen in overall equity market portfolio performance globally. On page 28, your bond allocation, and bonds do play an important role. They are the balance and the ballast, not to be all Marin on you, but it does keep us level and upright in choppy seas. And where we've seen the majority of the value in the yield curve that Pam was describing earlier, that's where the majority of the weight of your bond portfolio resides. Meaning that 10 years and in is where we see most of the yield. You don't get a lot of additional reward going out longer than that, and so the vast majority of your weight is in that, say, intermediate term. We may start to see that shift slightly and maybe lengthen out a little bit, but currently that's where we've seen the most value, we're seeing the most reward. The combination of price and yield has been found in that part of the belly of the curve. That concludes the portfolio review. Are there any questions or any highlights that you'd like me to address before we move on to overall economic overview? So a number of experiences that we've had over the course of the year so far, year to date. As was mentioned, international has outperformed while all the equity markets are up. In fact, if you think back to that chart, while the S&P is lower than it was through the end of the year last year, not markedly so, and all of the other indices are significantly higher than they were. So it's it really you have seen a raise. The opportunity really from diversification standpoint is a broadening out of the opportunities rather than necessarily a divergence or non-correlation, but the ability to pick up more good companies and opportunities and see their reward has certainly been beneficial. And if I look to page 31, the GDP, the U.S. GDP growth track has been an interesting one, to say the least, and we'll see now that the government appears to be reopening as we start to get numbers again, how this all shakes out. But the second quarter of 2025 was by all means a strong one and a return to a growth cycle, but an uneven one as we digest tariffs, as we digest a number of changes seismically within the overall economy. That a couple of the categories, that deep purple category kind of tends to skew the numbers a little bit, where you have, which is net exports and the measurement of trade, going severely negative in the first quarter and then severely positive in the second quarter has really impacted the overall GDP. So when we finally do see third quarter numbers, it will be interesting to see how that shakes out. I think the overall sentiment is that growth continues to be strong, but not super strong, and that we are seeing some signs that we want to pay attention to, but not necessarily react to at this point. The labor market drives so much, as it should, of what happens in a consumption-based economy such as ours. And the signs of a weakening job market are certainly with us. The term low hiring, low firing seems to be apt. Most of the challenges for low hiring appear to be in the younger cohort, people graduating from college or having a challenging time finding employment. But whether it's lessons from COVID or other factors, companies really aren't laying off in the same way, and when they are, it's more of a rationalization of the intense hiring they went through post-COVID, where they collected everybody that they possibly could. So again, this is another area where with the demographic shifts, with immigration shifts, we're all trying to kind of digest what any of these numbers mean, but I don't think there's any question that what we're seeing now is a solid labor market, but much like the overall economy, one where we're looking for signs to see what they mean, not ready to react yet, but aware of what's going on. And you see that with the unemployment rate and wage growth, where they can diverge, but ultimately they converge. And right now, where you're in a place where wage growth is let's say, moderate, and unemployment is low, that there isn't as much pressure for wage growth, because again, hiring isn't at the same clip it was immediately post-COVID, but we're in a bit of a low, let's say a low simmer right now with that, the wage growth and unemployment growth. Page 34, the headline is inflation concerns are subsiding, and that's fair. It's also, I would say, maybe part of the story, because I think that we feel an underlying sentiment of concern as while inflation is not certainly roiling at the 9% that it was a couple of years ago, prices at the grocery store haven't come down, and so that pressure is still there and still being felt. So I think there's at least an undercurrent still of a concern of inflation, but it is without question coming down. And it's the categories that we pay attention to. I take pains to point out that not everybody's inflation rate is the same. If you're heavily reliant on healthcare, if you're spending a lot of money there, your inflation rate's awfully high. If you're dining out a lot, your inflation rate's awfully high. If you're not doing those things, your inflation rate's not as high. I mean, so you just have different, we all have a little different mix, but prices are still adjusting. They continue to adjust. Tariffs have had their impact there. We'll continue to see that. But you also see on the next page, one of the reasons why inflation is moderating is that we are past a point where there is an excess of money supply. Additional money in the system drives inflation. It's going to be spent somewhere. And we are still starting to drag out some of the money that was spent while people were told to stay home during COVID, and that money went out while there was no production. That's going to lead to a lot of inflation. Well, we're still starting to, we're seeing kind of the tail end of that coming out of the system, which is why we continue to see inflation come down. And again, you have the countervailing factors of tariffs, so it's now kind of hovering in that high 2, low 3% range, and until one of those components breaks, we'll probably continue to hover in that space. The Fed has begun to lower the Fed funds rate. They just did it again, although with a very clear note that there's no future rate cuts guaranteed, and the lack of data is certainly impacting their decision-making process. So the two schools of thought are, if anybody's ever seen the movie Days of Thunder, do you put the gas down and go through the wreck, or do you slow up? And they're trying to make that decision right now, whether or not they continue to cut rates when they don't really have all the full data, with the fear of reigniting inflation, or do they lower the pressure on credit cards and mortgages and try and impact the U.S. consumer in that way. So there's a lot going on there, but we are in a rate cutting cycle. It's just a matter of how long between now and the next potential cut, based on the lack of available data. Fundamentals valuation and technicals is another way that we kind of explain our thinking on the overall market. We look at the fundamentals of the economy. We look at the overall valuations of the companies that we're investing in or the market, and then the technicals will be a confirmation of that. And rather than get into each of the individual points, the headline or the subheadline tells the story. Much like most of the points that I've discussed, there are signs of things that we want to make sure that we are aware of, whether it's employment, whether it's inflation, whether it's economic conditions that don't give us strong signals in either direction. And so we are cautiously optimistic in a neutral stance. Again, we see a continually growing economy, but with risks. We see an interest rate environment that is favorable, but with pressures. And so we are, again, cautiously optimistic, and our overall breakdown of how we see the component parts certainly reflects that, again, I'd say neutral stance at this stage. And then finally, it would not be a book if we did not conclude with a reminder that in every year, nearly every year, there is a significant decline intra-year. That does not necessarily mean, as it appears it won't this year, that we have a negative year overall. It appears, barring a real turn here in the last few weeks, that we will have a very strong year domestically and globally in the equity markets. But I can remember very clearly being here right around the tariff tantrum, like I think maybe the day of or the day after, and it feeling pretty bleak, and the market being at least intraday in an actual bear market position, and that happens, and it happens more often than it doesn't happen, and we remain aware of that, which is why we remain invested but diversified, and always with the mind of what your objectives are in keeping that mix. I will conclude with just a reminder of how we started the year. Our investment team on the equity side, led by our good friend Jeff Crumpleman, had made a S&P 500 target for year end of 6,600. They maintained that target even in April, when most of our peers were slicing their targets. We maintained that target when the market was roaring back, even when most of our peers were then re-upping their targets. And it appears, as we sit here today, we're going to be at least within shouting range of that target. It is that steady presence that we're very proud of, that we continue to provide and are excited to provide to Lextran as we move forward. So happy to answer any questions, but thank you very much.
Thank you. Any more questions? Thank you both. Next item on our agenda, old business. Anyone on the committee have any old business? Or new business? Hearing none, our next meeting is February the 10th. Is there anything else from the Committee for the Good of the Cause? Eric, you okay on the phone? I might have lost him.
Yes, I'm okay.
Okay, perfect. If there's nothing else, we stand adjourned. Thank you all.